Something just changed in the Middle East, and the market is already reacting like it knows the next headline won't be a flare-up, it'll be war. And when that switch flips, gold and silver don't move because a TV anchor said a scary word. They move because the world starts repricing trust, supply lines, and risk all at once. Right now, people online are screaming the same simple story. War headline hits, metals skyrocket. Clean, comforting, easy to repeat, and dangerously incomplete. Because markets don't run on one lever. They run on pressure. They run on positioning. They run on liquidity, and panic, and forced selling, and then the second wave where the real repricing begins. If you want to survive what's coming, you have to stop chasing the spark and start measuring the dry wood. That's the whole game. And before we go deeper, quick question. Where are you watching from today? Drop your country and the date you're watching because these moments matter, and it's wild seeing how global this audience is when the tape starts getting emotional. Now let's get surgical. Because if you've been scrolling, you've seen the bait. Gold is guaranteed to rip. Silver already did the crazy part, now it's safe. The next flashpoint will send everything vertical. And it sounds logical, until you remember something that keeps trapping people. Markets are not logical in a straight line. They're messy, and the mess is where people either get paid or get punished for believing a neat story. Here's the mindset shift that fixes most of the confusion. There's a difference between real risk and headline risk. Real risk is structural. Debt, deficits, supply chain dependency, shipping choke points, energy vulnerability, currency confidence. Headline risk is the moment the crowd remembers those weak points exist. So when someone says war is bullish for gold, what they usually mean is war reminds the crowd the system is fragile. That reminder changes behavior. Behavior moves price. But the fragility was there before the reminder. That's why you'll see terrifying news and gold barely flinches. And then you'll see a quiet day, and gold decides to sprint. If you require a clean reason for every candle, this market will chew you up. Not because you're dumb, because you're asking the market to be a calculator. It's not. It's a crowd, and crowds move when pressure builds. So let's talk about pressure. Because the reason this Middle East situation matters isn't just the emotion. It's that the world is already running hot. Rates, liquidity, debt, political stress, shipping lanes, energy pricing, the entire system is loaded. When the system is loaded, even a small spark matters. When the system isn't loaded, sparks die out. That's how you stay sane. Now let's address the biggest trap I see in metal conversations right now. People treat gold like it's only a fear trade, and silver like it's just gold but cheaper. Both ideas get you hurt. Gold doesn't have one driver. Gold has multiple engines bolted together. Central bank behavior, currency confidence, real rates and liquidity, momentum flows that don't care about your story. And yes, geopolitical tension. You can have gold rising while war headlines are quiet because the currency engine is turning. You can have gold flat during a scary week because liquidity is tight and positioning is crowded. That's why single-cause explanations feel good but fail at the exact moment you need clarity. Now, silver is even trickier. Silver is not a calm sidekick. It's a high-beta instrument with mood swings. It is partly monetary, partly industrial. It can outperform gold or underperform gold, and it can do both in the same month. So when people ask, if gold is ripping, why isn't silver exploding even harder? The answer is usually, because silver is getting pulled by two hands at the same time. Fear tries to pull it up. Growth expectations can pull it down. That tug of war creates volatility. And volatility isn't just emotion. Volatility is positioning. Leverage, margin, forced liquidation. Here's the part most people miss. The first move in a shock is often not gold to the moon. The first move is sell what you can. Because when the crowd gets hit, they don't sell what they want. They sell what's liquid. Sometimes that includes gold. Sometimes silver gets hit even harder because silver is more margin-driven and more violent. Then comes the second wave. The second wave is the repricing. That's when the market asks, what broke? What's scarce now? What's unsafe now? That's when gold starts acting like collateral. Not a trade. Collateral. And that word matters. Collateral is what people want when trust starts shaking. Now keep that in your head, because this is where the Middle East escalation becomes more than a headline. If the conflict widens, the market doesn't just price bombs. It prices insurance, shipping routes, energy risk, supply delays, political responses. And the bigger one nobody wants to say out loud: what happens if a regional conflict becomes a multi-front stress event? What happens if you get geopolitical stress and economic slowdown at the same time? That combo is where outcomes get wild. Gold often loves that environment. Silver can still do well, but it can also get whipped hard before it behaves. And that's where people blow themselves up. Not because they picked the wrong direction, because they sized it wrong, because they expected a straight line, because they couldn't tolerate the path. Let's talk about the path. Because after the rocket phase, markets often change character. The rocket phase is the crowd rushing in, leverage rising, volatility spiking, candles getting ridiculous. Then you get the slap, the reset, the lesson. And after that, you often enter the grind. 2 steps forward, 1 step back. Uptrend remains, but the ride becomes annoying. And this is where most people lose money. Not at the bottom, not at the top, in the middle. Because the grind is where confidence decays while price climbs. It feels unfair. It feels boring. It feels like the story died. But it didn't die. The market is digesting. And digestion is where the next move gets built. That's why you should train yourself to prefer trends over fireworks. Fireworks are rare. Trends are where wealth is made. Now let's put this into a usable framework. Think of gold like it has 3 gears: fear, currency confidence, rates, and liquidity. When all 3 gears turn together, you get the "what is happening" moves. When only 1 gear turns, you still get movement, but it's choppier and less clean. So yes, conflict can be the fear gear, but you also have giant deficits. You have government spending like resilience is free. You have reserve diversification happening quietly. And you have a system that keeps reminding people it's running on confidence. Here's the skeptical truth that people hate hearing. Sometimes the market uses war headlines as the story to justify a move that was going to happen anyway. Not because war is fake, because the market is a storyteller, and it's not always honest. The tape grabs the most emotional explanation available and slaps it onto price. So the better question is not, did gold jump because of war? The better question is, what was gold doing before the headline? Was it already trending? Was it coiling? Were real rates shifting? Was liquidity easing? Because if the structure was bullish already, the headline is just the match. If the structure was bearish, the headline might create a spike that fades. And that's why people get trapped. They buy the spike. They call it confirmation. Then the market fades it, because the structure didn't support it. So when you hear Skyrocket, replace it with the real translation. Higher volatility. Higher probability of a higher long-term price. Those are not the same thing. Now let's anchor this to the world in front of us. You've got precious metals sitting at elevated levels relative to where most people first discovered them. Gold is acting like a reserve asset. Silver is hovering in a zone where every move feels amplified. And at the same time, the world is dealing with 2 types of tension. Immediate tension, headline-driven conflict risk. Structural tension, great power rivalry, supply chain competition, strategic resource reshuffling. If you're holding metals, you need to know which tension you're pricing. Because if you're buying based on the next headline, you're trading news. If you're buying based on structural tension, you're positioning for a regime. Different game, different mindset, different risk management. And here's the quiet killer. People confuse later with never. If markets start pricing probably later, you can still have an uptrend, but with less frenzy. That's the grind. The grind is not bearish. The grind is not, it's over. The grind is the market breathing before the next oxygen-stealing sprint. Now let's move from vibes to mechanics, because mechanics is how you avoid being emotional prey. The most useful reality check in this whole conversation is supply chain dependence. Modern economies are not self-contained. They are webs. And the tighter the web, the bigger the ripple when one strand snaps. In a serious confrontation, the first pain isn't in flashy consumer gadgets. It's in boring components, industrial inputs, processing capacity, shipping, insurance. The basic stuff that keeps everything moving. And that's exactly why conflict matters to metals. Because metals sit underneath the real economy. They're part of the skeleton. They are real stuff. And real stuff gets more valuable when the world becomes less cooperative. Here's what's happening in plain language. The world is moving from optimizing for efficiency to optimizing for resilience. Resilience costs money. Resilience means duplication, inventory, redundant routes, onshore and friendshore manufacturing, more defense spending, more grid spending, more infrastructure spending. And when you spend on resilience, you pull forward demand for physical inputs. You don't get resilience for free. You pay for it with commodities. That's why this isn't just a war trade. It's a repricing of the world. Now, if you listen to people list themes right now, it can sound like a random shopping cart. AI, nuclear build-out, copper, oil later, undersea cables, critical minerals. It sounds scattered until you see the single thread. Infrastructure under stress. That's the theme. AI is not just software. AI is servers, cooling, power, transmission lines, backup generation, and a lot of copper. Nuclear is baseload power and grid stability in a world where electricity demand is rising. Copper is everywhere modern expansion happens. Oil is still the bloodstream of trade. Ships, jets, trucks, and industrial inputs don't stop needing energy because someone gives a speech. And undersea cables are the nervous system of global finance and communication. Now here's the cliffhanger hidden inside that list. If cables are the nervous system and energy is the bloodstream, what happens when conflict turns those into targets? Or even just risks? Because markets don't wait for certainty. They reprice probabilities. If the probability of disruption rises, capital moves, insurance moves, hedging demand moves, and that's when hard assets start acting like protection instead of speculation. Now, about undersea cables specifically, people argue in extremes. Either everything is sabotage, or everything is a boring accident. Reality is usually mixed. Accidents happen. Sabotage exists. Sometimes accident is conveniently timed. But here's the part that matters for markets. Even if the cause is boring, the response is expensive. Governments and companies spend money on resilience, monitoring, redundancy, more routes, more repair capacity. That spending is real. And when spending becomes real, the commodity layer underneath it becomes more relevant. So yes, you can talk about conflict, but the deeper story is this. The world is reorganizing itself, and reorganization is commodity intensive. Now bring it back to gold and silver. Gold tends to behave like collateral when trust degrades, and silver tends to behave like the volatile cousin that can front-run the move, or lag it, depending on growth expectations and positioning. That's why silver can feel less manic even in an uptrend, because after a leverage flush, volatility can compress while the trend stays up. A grind phase is not boring because the story died. It's boring because the market is rebuilding the base for the next move. And here's the scary part. In that rebuild phase, the crowd gets impatient. The crowd wants fireworks. When fireworks don't show up, the crowd sells. Then the next sprint happens without them. That's how the market steals your position. Through boredom. Through annoyance. Through, I'm done with this. Now let's address the word everybody loves. Skyrocket. Could gold and silver spike if the Middle East escalates further? Yes. Could they spike if other global flashpoints intensify? Yes. But skyrocket implies a clean move with no pullbacks, no traps, no volatility. That's fantasy. A healthier model is a staircase during an earthquake. The staircase still points up, but the building shakes. Sometimes you slide down a step. Sometimes you get shoved sideways. Sometimes you think you're about to fall, and then you catch yourself. That's what a real regime shift often looks like. Now here's where you make this personal and useful. Why do you own metals? If your answer is, to get rich fast, you're going to hate the grind, and you'll likely over-leverage the worst instrument for that goal. If your answer is, to hedge a world that is becoming more expensive and less stable, then you can accept boredom, pain, and volatility as the cost of protection. And that difference changes everything. Because the purpose of this conversation is not to make you more emotional. It's to help you make decisions that don't blow up your life. So here are the practical rules that matter in this environment. Rule 1. Be careful with leverage. Leverage turns volatility into a forced decision, and forced decisions happen at the worst time. Rule 2. Position size is the real cheat code. If you can size it so you can hold, you win. If you size it so you panic, the market owns you. Rule 3. Stop demanding clean narratives. The market will not give you that. The market gives you probabilities and pressure, and your job is to manage risk inside that reality. Now, one more uncomfortable truth. In shocks, the first wave can punish everyone, even the people who are right long-term. That first wave is liquidation. The second wave is repricing. So if you see metals dip on scary news, don't immediately conclude the thesis is dead. Ask the correct question. Is this liquidation, or is this repricing? Because liquidation fades when forced selling ends. Repricing continues when the system revalues risk. That's why it can look confusing in the moment. Now let's talk about why gold keeps getting treated like a reserve asset even at high levels. Because big players don't trade gold like you trade it. They manage vulnerability. They don't need perfect timing. They need reduced exposure to a world where access can be denied, where rails can be blocked, where settlements can be politicized, where supply can be disrupted. In a world like that, assets that settle without someone else's permission become more valuable. And gold has played that role for a very long time. Now, silver's role is more complicated, because silver is also an industrial input, which means it can be sensitive to growth and manufacturing cycles. So silver can get shaken more violently during risk events. But if the bigger regime is real stuff gets more valuable, silver can still be pulled along, sometimes late, sometimes early, often with drama. That's why silver is not a set and forget emotional instrument. It demands respect. Now let's zoom out again. The system is changing. We are leaving a world that tried to minimize cost and maximize speed. We're entering a world that wants redundancy and security. That means more factories closer to home, more inventory, more spending on grids, more spending on defense, more spending on shipping resilience. And you know what all of that has in common? It's expensive, and it's physical, and it tends to raise the price of inputs. That's the macro backdrop. That's why metals matter. That's why energy matters. That's why industrial metals like copper matter. That's why boring infrastructure might end up being the biggest story of the next decade. Now I want to pin you to a decision framework with one simple question. If you could only overweight one category for the next cycle, what would it be? Precious metals, energy, industrial metals like copper, or the infrastructure picks and shovels behind AI and grids? Pick one. Drop it in the comments. And tell me the reason in one sentence. Because the reason reveals how you think, and how you think determines whether you survive the volatility. Now let's land this plane with the clean takeaway. The takeaway is not, war is coming on a date. That's not analysis. That's a bumper sticker. The takeaway is, the market is repricing a world where conflict risk is higher, supply chains are being rebuilt, and capital is moving towards strategic infrastructure and hard assets. In that world, gold can keep behaving like collateral. Silver can keep behaving like a high beta partner with mood swings. And the broader commodity complex can become more relevant than most people are psychologically ready for. But the path will not be smooth. The path will punish impatience. The path will punish leverage. The path will punish people who fall in love with a clean story. So keep it simple. Respect volatility. Size positions so you can hold. Stop chasing sparks. Track the dry wood. Because when dry wood piles up, the next spark doesn't need to be big. It just needs to be real. And if you want more breakdowns like this, fast, direct, no wasted time, subscribe. Short, simple, stay ready. One last reminder before you go. This is general education and discussion, not personal financial advice. Make your own decisions, and if you need tailored guidance, talk to a qualified professional who knows your situation. Now drop your location and your one overweight category in the comments, and keep your eyes on the system, not the headline. Because the headline is the noise. The system is the signal.